Ladies and gentlemen, good day and welcome to the UGRO Capital Limited Q1 FY24 earnings call. At this moment, all participants are in the listen-only mode. Later, we will conduct a question and answer session. At that time, you may click on the raise hand icon to ask a live question. Please note that this conference is being recorded. I now hand the conference over to Mr. Vinay Pandit from Captify Consulting. Thank you and over to you.
Thank you. Ladies and gentlemen, I welcome you all to the Q1 FY24 post-earnings conference call of UGRO Capital. Today on the call from the management, we have with us Mr. Sachindra Nath, Vice Chairman and Managing Director, Mr. Anuj Pandey, Chief Risk Officer, Mr. Amit Mande, Chief Revenue Officer, and Mr. Kishore Lodha, Chief Financial Officer. As a disclaimer, I would like to inform all of you that this call may contain forward-looking statements which may involve risk and uncertainties. Also, it's a reminder that this call is being recorded. I would now request the management to detail us about the business, the performance highlights for the quarter that went by, the growth plans and the vision for the coming years, post which we will open the floor for Q&A. Over to you, sir.
Thank you, Vinay. Good evening, everyone. I'm Sachindra Nath. This is the Q1 FY24. But for me personally and for UGRO's team, what is the most exciting that we are demonstrating our capabilities to be the India's largest small business financing platform, which is in making. Actually, small business financing, which has been an excluded segment from the mainline credit industry, is becoming the mainline. The growth, the explosion of credit, which you have seen in the consumer financing business, the power of the data, and supported by technology, is on the verge of an explosion in terms of the credit. I would actually, before we go to the financial numbers and what we have done in quarter, as business builders, we always look businesses from a 5-year and 10-year view. But for all of you, it is important to understand that why this segment of the market is at the inflection point for this explosion of credit which we are talking about. You go to the slide 1. So in fact, when we were building up our investor relation presentation and rather than going straight to our numbers, we always like every quarter to reassess the market and where we are. When we prepared this, we ourselves were extremely surprised. If you look at the expansion of credit, which has happened between 22 to 23 for MSME, it was 52,800 crore. And the negative expansion, which is the reduction of the credit which happened in 21-22 was 61,000 crore, which means that we have still not reached to the level of pre-COVID time when it comes to MSME. That is just one part of it. But what is more stark, if you look at the FY17 data and FY22 data, I think so during this period of time, large number of new MSME financing players have emerged. Banks have refocused in India on MSME credit. From a wholesale credit, everyone is going retail. But the gap of the formal credit availability have grown. In FY17, the gap, the total MSME credit demand, and this is the data which comes from IFC and few other public sources, was 69 trillion rupees, which means that if you divide, reduce by the credit which was made available, it was 53 million of the credit gap. And in FY22, it has moved to 106 trillion, which is an 85 trillion gap. We view this, that the opportunity and the need is for not just one UGRO, but hundreds of UGROs to emerge to fulfill this gap, because existing credit system of the India is completely, undercapitalized and insufficient to fulfill this gap. If you go to the next slide. Why we think so that this would accelerate now. I keep saying that there was a point in time when consumer financing in India was similar to what the MSME financing is today. 10 years or 15 years back, if you want to go and buy a car or a fridge or a TV, the credit was roughly coming in 30 days time. Today it comes on tap. That has happened because some of the large players emerged, and also the data around CIBIL and the personal data of the consumer behavior, the repayment capability got established starting between 2008 to 2012. And exactly same revolution in terms of data repository is happening in India. The number of GST pair in last 5 years have increased by 50%. The UPI volume, which is also demonstrate the repayment capability and cash flow assessment, has gone up 12x. The UGM registration, which we still feel is one single data repository which will catapult the MSME credit, has gone up by 13x. Then the formalization of economy is happening at an accelerated pace. So total ITR filed has gone up by 37%, and large number of that new income tax returns is around MSME business. The MSME registration, which means it is also a sign of formalization of economy, has gone up by 80%. And linked account, which is one single method through which credit underwriting and cash flow underwriting would be possible. So an account aggregation through which you can fetch the financial data has in a very short period of time has gone up to 4.1 million linked data accounts. Next. And from there, we in our last conversation explained you around our capability of what we are doing around data and technology, how our growth score is designed and run, how our growth score has an ability to say both yes and no to the customer, and why we think so that we have a superior capability of figuring both improving the turnaround time for the customer, but also maintain credit cost, divide customers. And before it goes to the funnel of what conventionally understood is the conventional underwriting funnel, which is the credit officer, how he does it, where we have done a specialization. So all of that was explained in great detail in our last quarterly result. Those who are joining us for the first time, the recording of that is still available on YouTube. You can go and look at it. But I would request Anuj to now take you through that, how that engine is extremely superior, because that engine has been built on capability of machine learning. Anuj.
Yeah, thank you, Sachin. Good evening, everyone. So as Sachin was saying, we have been demonstrating the effectiveness of our internally developed underwriting scoring model based on GST, banking, and bureau for some time now, and we have been presenting the risk ranking which is coming out of that. But today in this slide, we wanted to take you to a little more detail on what all the back-end work and investment which has happened, which has resulted in this. And also during the course, we would like to give you a glimpse of what all is possible in future. We have already seen the kind of evolution of data ecosystem, and some of the numbers in the previous slides were literally quite large and amazing. And we all are very clear on what the potential is. To encash that potential, from day one, we were very clear that the platform has to be cutting edge. And the machine learning platform which we have built, we are very proud of that. Just to take you through the platform itself and our approach in a little more detail, you would see there are 4 modules of our machine learning platform. The first one is data ingestion. It is primarily a design of the system where the input data itself is in digital form. It is a very logical and intuitive thing, but for legacy large banks and other financial institutions, this is the biggest problem they are facing at this point in time. And when we were designing the system, we were very cognizant of that. So we have designed a system where all the critical data is sourced through APIs from validated sources outside, and we host all that data in a cloud infrastructure where it is very easy to deposit and retrieve. So our data ingestion module is by far one of the most modern modules in very similar industries. Then comes the second module, which is the feature engineering. The most critical part of this is to store data in a format where the machine learning codes can derive features in a centralized processed data layer. And that data layer then pulls out in a feature library which is quite proprietary in nature. This has been designed keeping in mind our end target segment, and all the data features are extremely relevant to the GST returns, the banking behavior, and the repayment behavior for small and medium enterprises. Also, there is a very large integrated network of this with other applications so that real-time information is exchanged. For this, we are on AWS platform, and the idea is to to use the most modern databases and the most modern infrastructure which is available. So this we have done right from the design stage. On the most critical model development stage, today we have more than 10 models inventory. We use not only the traditional predictive modeling and machine learning algorithms, but we have started using the natural language processing codes as well. In addition, the time series analysis and forecasting, which has features, are being used, and we use all the leading model development languages for machine learning, including Python, SAS, and SQL. This is the area where we have done the most investment. The talent acquisition and the people who are required for this have been taken from the most premier institutes, and now we have created a separate office for them so that there is less distraction. So this is going to be the intellectual property builder for the company in years to come. Lastly, but not least, is the capability to deploy the models during BAU and running businesses. Here also, we have internally developed the central rule engine, which can be configured, and the models can be deployed in real time. So overall, in all the 4 modules, during the course of last 4 or 5 years, there have been tremendous insights, and going forward, we will not only use this as a credit underwriting tool, which is the growth score, which is our flagship growth score, but in other facets of business as well. For example, applying network science analytics for our supply chain business, or for trigger-based questions to be asked when we meet the customer, etc. We have also made available our flagship growth score on our website for small businesses to apply and see for themselves where they stand and what are their insights on how to make it better. So I would encourage you and your known people and other MSMEs to come to our website and see for themselves. Next slide, Jay. This is a standard feature now, which we have been covering for last many quarters. Here, what we do is we check the efficacy of the internally developed growth score on how it is doing. Just to recap, what we do is out of approximately every 100 cases which applies for a loan, we end up giving loans to about 30. But our proprietary growth score is run for all 100 people, and we keep going back and seeing how they are performing even when they have not got the loan for us. So there are 2 lines on the graph which you can see. The lower ones are the performance of customers whom we have disbursed, and the higher ones are the performance of the customer whom we couldn't disburse. But we keep checking whether their repayment behavior was in line with what our internal growth score had defined for them. And so far, for last more than 2 years, the risk ranking of our classification has been steady, and this result is very encouraging. This helps us to increase the width and to keep checking whether the growth score is directionally working well or not. And I'm very happy to share with you it is working quite well. On the right hand side, you can see a pie chart. This is the composition of our overall portfolio. You would recall growth score gives risk classification in 5 bands: A, B, C, D, E. A being the best and E being the worst. Today in our portfolio, A and B combined is about 86% of the portfolio, which is where we want it to be. This is the top quartile customers from everyone who have applied with us. Move forward. So now I'll invite Amit to take you through on what all this holds in near future and how the business parameters are likely to be impacted and give some direction.
So all of you who would have been tracking us over the last few quarters, you would have seen we've been tracking against a milestone goal in 2025, and we've been giving guidances, we've been wanting to get to a particular number, and so and the results have been encouraging. We've been tracking absolutely as per plan. This is as we continue, we will keep strengthening, or rather we have very strong pillars, and we'll keep strengthening our three pillars essentially that will help us get to our plan. First, of course, is our data take-back risk assessment, which Anuj explained. Second, which is the core to our organization, is the lending against service model. So we will continue to do an on-book and off-book kind of a hybrid AUM, and we are tracking well on that as well. And third, of course, is a well-diversified product portfolio and distribution, where we actually service every need for every MSME, which means by 2025 we will want to get to about a 30% loan growth on a sustainable basis. Our off-book AUM on back of co-origination and co-lending will be at about 50%. The cost-income ratios, and I will I'll comment a little more on this when we come to the next slide. We want to get to a 45% cost-to-income ratio. Credit cost, thanks to our very robust risk models, currently are far lower, and we want to even keep it below this 2% mark, thereby delivering to the investors and the stakeholders an ROA of 4% and ROE, or return on equity, of 18%. Zainab, you want to go next? And how are we actually doing this? So we've kind of tried to plot this over the last few quarters, and firstly, our disbursements. There has been a steady growth on disbursements quarter on quarter. Currently, we are disbursing about 1,200 to 1,400 crores, or about 13 to 1,500 crores in a quarter, and this will continue to grow steadily. Look at our off-book AUM mix. We had given the guidance of about 50% on our last slide. By 2025, we are already at 43. We will end this year close to 47. So that helps us sweat our capital better. Credit cost, of course, are in control at 1.3% quarter on quarter. Coming to the cost to income ratio, sometime last year when we were at 72%, we explained that we put in a lot of infra during the post-COVID times to really build an organization to scale. And now that this whole infra and the machinery has started delivering on our AUMs, on our revenues, and on the controlled credit cost, we are seeing a steady decline on our cost to income ratio. We are already at 55%. Our aim is to be at 45% by 2025. In my judgment, we should get there even before that. But at this point in time, we are tracking very well on our cost to income ratios. All this has only led to a better ROA this quarter. We are at a ROA of 2.2%. So having said this, overall, the business matrices look very encouraging, and a quarter on quarter, we've been only getting better. Then next. To give you a quick brief of the performance highlights, Kishore, I invite Kishore to do this. Kishore, our CFO, who obviously has been here for last 3 quarters, will take you through this. Kishore.
Thank you, Amit. So as far as asset under management is concerned, we have closed this quarter at 6,777 crore, which is 85% growth on compared to last year on the same period, and 11% growth compared to the previous quarter. Gross loan originated is about 2,036 crores during the quarter, which includes a supply chain financing, and if we exclude that, then we are closer to 1,300 crore, which is a 50% year-on-year growth. Compared to last quarter, there is a slight dip. However, we are quite confident that as the time progresses, so we will surely catch on that. Portfolio yield is 17.3. It has slightly increased over the last few quarters, and it is consistently increasing because of our focus on high-yielding products, as well as increasing some amount of yield on the existing products. On profitability side, total net income during the quarter is 125 crore, which is 82% YOY. Pre-provisioning profit is 56.6 crore, which is 187% YOY and 11% quarter on quarter. Pre-tax profit is 35.6 crore during the quarter. On the same quarter last year, we were closer to 10 crore, so it is almost 243% of the last same comparable period. Last quarter, we were closer to 33 crore, so there is 6% quarter on quarter increase as far as pre-tax profit is concerned. On the asset quality side, as Anuj and Amit has explained, that we have a very robust underwriting mechanism which is managed by both machine and man. So we have a hybrid model where our growth score do the first level of assessment, then we have credit officers who do the PD and do the physical check on the customers, including the fraud control unit, which is resulting into a robust portfolio. Our gross NPA is closer to 1.8% and net NPA is about 1%. Collection efficiency is hovering around 97%, which is consistent over last 5 quarters. On borrowing, our total borrowing is about 3,342 crores during the period ended 30 June. Total net worth is close to 1,300 crores, so our leverage is close to 2.5 times as of now, which is steadily increased as we increase our total book during the year. Cost of borrowing is about 10.66% during the quarter, which has marginally gone up compared to the previous quarter. These numbers, actually, we have already explained that AUM has gone up by 85% compared to the previous period. Net disbursement has gone up from 917 crore to 1,284 crore during the quarter, which is 40% growth. Our book, as Amit explained, that has almost double compared to the last year. So we were at 21%. Now we are at 43% of the total book. And our targeted book is about 50% in next 6 quarters. Total income, net total income is about 12.5%, which is 22% growth over the corresponding period. Cost to income ratio has steadily gone down. By the year end, we should achieve about 47%. As of now, we are closer to 55%. Adjusted return on total asset is about 2.2%. Which was about 1%, so we have done significantly well here. And return on equity is about 8.7%, which was 3% last year. And capital adequacy is about 27%. Out of this 27%, primarily it is coming out of tier 1 capital. There is hardly any tier 2 capital, so we are well capitalized at this moment, and total leverage is about 2.5 times. This quarter, our EPS was closer to 3 rupees per share. So if we just though this is not totally comparable, as we progress, our profitability will increase. But based on the current quarter profitability, our EPS, annualized EPS would be roughly around 11.34 rupees. Our book value is 145 rupees. At many places, we observe that post our equity infusion, it has been stated as 110 rupees because people have added the number of shares that we have issued during the quarter, but not added the quantum of money that has come into the equity. So at many places, you would find that our book value is reflecting at 110 rupees. Actually, it is 145 rupees. Our price to earning ratio based on the current quarter earning is roughly about 24 times based on yesterday's price.
So we will stop here because the objective is because our investor presentation is quite extensive. It covers portfolio quality, it covers our shareholding structure, it covers our management, it covers our board. In fact, we have just before we invite for questions, we have just added a new board member. Our previous board member, Smita Agarwal, have been appointed as Director, United Nations for Global Financial Inclusion, and that's why in her full-time capacity to United Nations have to move off our board. And given that over the last 2 years, we have seen a large number of public market shareholders coming into the company, some of the new institutions have come, and some of the marquee public market investors have also come. And we wanted to add, as you know, in terms of the governance, our articles provide that the majority of this company's board would be independent. So that's why we are independently supervised. We are professionally managed, and we are institutionally owned, independently supervised, and professionally managed. So a large portion of our ownership is in the hands of private equity, which is now getting in the hands of much broader population. And in order to make sure that the company and its management delivers to what is comparable to the market, we added a capability or a person who has been tracking financial services industry for very long. So Tabassum Inamdar, who was the head of financial services and BFSI research for Asia Pac of Goldman Sachs, have joined our board as an independent director. All of these details are in our further lectures, but I welcome participants to ask questions, and management will be happy to answer. Thank you. Over to you, Vinay.
Thank you, sir. We can begin the Q&A.
Certainly. Thank you very much. We will now begin the question and answer session. To ask a question, please click on the raise hand icon available on the toolbar, or you may click on Q&A icon to raise hand. The operator will announce your name when it is your turn to ask a question. Please accept the prompt on your screen and unmute your microphone while proceeding with your question. To ask a text question, you may click the Q&A tab and type your question. We have our first question from Anil Tulsiram from Contrarian Value Edge. Please go ahead.
Yeah, can you hear me?
Yes, Anilji, welcome back. We can hear you very well.
Yeah, thanks. Thanks a lot, sir. Sir, my first question is on prime unsecured book. I understand the ticket size is 17 lakhs and the interest is around 19%. So I had interacted on this question earlier and I was told the customer are same as the prime secured customer with turnover of 200 crores and healthy banking habits and own residence, etc. What I'm unable to understand is why these customers are willing to pay 19-20% just because it's a short-term loan and faster processing time. Will the customer pay such higher interest rate? And a related question on this is what exactly do we mean when we say prime customers? Thank you.
So I will answer the second part of the question first and then come to the first question, which is an age-old question. The way we have defined prime customers is through three parameters. One is the quality of cash flow. Second is the quality of repayment behavior. And third is quality of collateral. So if the quality of, and by quality of cash flow in MSME terms, basically we mean whether all the cash flow can be evidenced in the reports which customer files. For example, in GST or in banking, etc. If there are some cash businesses which are not in GST or banking, then the quality of cash flow is not prime as per our definition. Quality of repayment behavior is defined by our proprietary growth score. So if the customer is in the top 2 quartile of repayment behavior, we consider him prime, otherwise not. And for secured loans, if the quality of collateral is a prime property with a very clear and marketable title, then it is a prime property. So depending on these three, we classify our customers in within degree of primeness. For unsecured loans, we only do prime customers, which basically means the cash flow is prime and the repayment behavior is prime. Now coming to your first part of the question, yes, there is a clear premium to command if one is able to give loans to customer within a stipulated short period of time. For MSME customers, and typically our set of MSME customers, which are micro and small, time is of essence. And most of them, because they have smaller turnovers and don't have too much collateral to offer, only can avail unsecured loans. There have been many large success stories in India who have built their businesses, lending businesses in this field. Bajaj is the prime example. Unsecured loans pricing has been pretty inelastic. The amount of demand doesn't go up or down with change in interest rate. This has been pretty set up historically. So yes, there is a very large market of MSMEs in India who take unsecured loan for a short tenure between 2 to 3 years, at 19% or more rate.
Yeah, sir, actually, I was told these customers have turnover of up to 200 crores, and that caused the confusion. So, can you describe your customers in more detail? What is the profile of these customers, their typical turnover and the loan limits, etc.?
So our sweet spot of customers is micro and small, and within that, more than 80% of the customers in our portfolio would have turnovers between 50 lakhs and 10 crores.
Okay.
So this is our target profile.
Got it. And sir, one last question, if I can. The large part of our AUM is again focused on ticket sizes of 30 lakhs and more. And we are focusing, the way we underwrite is we use the digital stack in GST and banking, which is like entirely, it can be digitized. So what I want to ask is, if we look at the majority of the NBFCs, they are focusing on lower ticket size and difficult to underwrite segment, like where cash flows are not very visible in the banks and you have to do surrogate and others. So why have we chosen this strategy where banks can compete very easily rather than the strategy where banks are finding it difficult to compete? So can you explain the rationale?
Okay, so I will, and this is also is an age-old question. In theory, yes, all this data is pretty democratized, and everyone has access to that. But the trick is to apply it smartly to the target segment, which gives demonstrable results. We have chosen to be in underserved segment, not unserved, because our way of underwriting relies a lot on statistical platform templated underwriting. For that, you need some history of repayment behavior and banking behavior. But that doesn't mean that these people have many choices today. So the way this is operated is people who have been able to apply these models and are able to give a constructive solution or a loan to the customer with a very reasonable turnaround time. There's a very large market still to capture.
And I would add, Aniji, the other thing to consider that what you are seeing today is not what you will see, in 2 years or 3 years of time. We, through 4 of our channel, services all type of customer profiles. So we also focus on micro enterprises customer, wherein the GST and the banking data is thin, where you have to build massive physical infrastructure, you have to underwrite manually, and where we are seeing the improvement in the data capture in terms of the banking behavior and GST behavior is coming up. But that's a slow build. In last 2 years, we went to 5 states. We opened 75 branches. Those 75 branches are delivering us roughly around 70-75 crore per month. And we don't want to increase OPEX. We are seeing the maturity of that. Over a period of time, for mainline banks to break through that segment of market continues to be difficult. So we will keep expanding that. So the color of this would change. But as Anush said, that even in the segment wherein you think the data is available to everyone, first the gap which I showed you on the first slide itself is widening. So there is an opportunity for everyone. Generally, banks like to do even much bigger ticket size. Second, the 5 year of journey and the hard effort we have put for any financial institution to catch up there would take few years. And by the time we will again, go ahead by few years. And that is also one of the reasons why largest financial institution of this country partner with us and do code lending, because I think we have created a moat which people realize that moat is difficult to replicate immediately. Some of them would, which is okay, but otherwise they are partnering with us.
Thanks a lot, sir. Thanks a lot for a very detailed answer. Understood. Thank you.
Thank you. We have a next question from Chinmaya Bhargava from Badrinath Family Office. Please go ahead.
Hi, thanks for the opportunity. I have a couple of short questions. The first is in our quarterly disclosures, there's a hit of about 6 crores under cash flow hedging losses. Could you just say a little bit about what this is and the nature of these losses?
So actually, it is not in P&L hit. So whatever ECB borrowings that we do, these are fully hedged. But technically, you have to report it this way that whatever is the rupee differentiation come between the quarter, you have to disclose it that way. But there is no P&L hit per se. So entire principal plus interest we hedge fully.
Okay, thank you. The second question is looking at the annual report in FY23. In your breakup of your segment under machinery finance loans, it looked like 59% of your AUM there was to the hospitality segment. Could you describe a little bit about why the breakup was this concentrated?
No, I think there is some confusion. Most of our machinery loan portfolio would be under light engineering and not hospitality.
Okay, but the breakup was about 59% to the larger segment, right?
No. Where you are seeing this?
It's in the annual report.
Annual report is in front of us. Oh, no, this is not annual report. Actually, we will check that, but no. But I think so. I would request you to go through the investor presentation and look at the portfolio construct there. And if you can point out where in the annual report you found it, we'll surely check that.
Okay,
But
I'll
what was
connect
it?
with you after. My last question then here before I jump back onto the queue is if you could share a little bit about, GrowX since we launched, how many users we've managed to onboard there, what we've disbursed under that platform, and how it's going at the moment.
Yeah, so on the GrowX, we are not yet disclosing numbers. The reason for that, it's still what we call is the beta test one version. We expected, we don't want to grow exponentially while the total number of download, the response, the approval rate has been exponentially high. But given the nature and the type of the customer, we are controlling the total portfolio which will generate over there. We are also, testing, and as you know, the credit was on the UPI. RBI is supposed to come back with their regulation on the UPI, so we are waiting for that to happen. As we have said, I think so at the beginning of the launch, that this is the demonstration of our data plus tech capability, but over a period of 1 year, the total book we want to create is not more than 100 crore in the initial period of time. Till the time we fully test it out, the credit behavior of that, I think so we achieved around 5% of that target.
Okay, thank you. I'll get back into the queue.
Thank you. We have our next question from Ruchita Kadge from iWealth LLP. Please go ahead.
Hello. Good evening, sir, and congratulations for a good set of numbers. So my question was regarding your income on co-lending, which has kind of gone down from what it was last quarter. So if we look at the yield on that book, that has also gone down as a percentage. So if you could just explain on that a little bit.
So last quarter we have done the volumes on co-lending as well as DA was significantly higher compared to this quarter. That is why you would see that last quarter our total co-lending plus DA fronted income was closer to 63 crore, which has come down to closer to 43 crore this quarter. It is sheer factor of volume that we have done. There is no change per se on the rate side because these are all pre-negotiated rates that we agree with on co-lending side for most of the banks, and on DA side rates don't vary quarter on quarter that much. So it is a sheer factor of volume. We have done large volume of DA and co-lending in the previous quarter, especially in the fake end of the last quarter. This quarter typically it pick up from the quarter one and then gradually build up till quarter four. So this quarter the volumes were significantly lower compared to the previous one.
Also, just as the market construct, Ruchita, as you know that 100% of our asset is priority sector asset. Generally, the banks are always in dire need of adding more priority sector asset by end of the financial year. And so, as you know, there is a lot of customer who want to borrow before close of financial year. So you will see this in cycle. The Q4 of lenders like us would be a little ramp up, and Q1 would be a little lower. But on a normalized curve basis, we would achieve what we have targeted for the year.
But at the same time, you should appreciate the fact that despite having upfronted income lower by almost 20 crore, our PBT has gone up.
Yeah.
Yes, yes. Thank you, sir. One more question that I had was on the AUM. So earlier, your target was around a 20,000 crore AUM by FY25, right?
Yeah.
FY25, by
Yes.
FY25 end. So,
Yes.
are you like going to trim the guidance, or how do we look ahead?
Ma'am, look, we give guidance to ourselves and to the market, right? These guidance on
Yes.
basis what we want to achieve. These guidance, I think so. AUM actually for shareholders and investors, more than AUM, it is the bottom line performance which actually deliver the value. But AUMs give you a size sense of the kind of institution is getting created. Where we are right now, if you look at our average monthly AUM increase of by 500 crore or a disbursement run rate of 500 crore, half of that we will achieve this year. And by the time we will be ending the year, our exit run rate should be around double of what we are doing right now, because that's the way the capacity would get built. Which means 24, 25, we should add another 12,000 odd crore. So this year's of AUM, last year of 6,000 crore of AUM, added for this year's roughly around 10,000 crore, and then incremental 12,000 odd crore. If we would be, God willing, we should be at 20,000 crore or to 18,000 crore. We really don't know. It's too difficult in our markets to predict that. But all said and done, we will deliver the bottom line performance of what we have showed in our first few slides in terms of return on asset, return on equity, cost to income ratios, and sustainable growth rate.
Okay, sir. Understood. Understood. Thank you so much.
Thank you. We have a next question from Vijay Chauhan from RHPMS. Please go ahead.
Yeah, thank you for the opportunity. I just had one question regarding the asset quality. So there is some marginal increase on the quarter-on-quarter basis. So if you can shed some light, that will be helpful. And also, like we have done fantastic execution, and we have been tracking this business for a long period of time, almost since the rejig from the older days, and the execution has been fantastic. So we also would like to understand what are the like risk measure there we are applying additionally once we hit the, let's say, the 10,000 crore and 20,000 crore mark, because now our execution engine has robustly shown the successful execution in terms of loan book growth. So how we will do on the asset quality side? Yeah.
So the three questions that why there is a marginal deterioration in asset quality. Second question, I will take that what additional risk measure will apply once you reach a scale, because your execution till date has been good. I think these only those two questions, right?
That's correct.
Yeah, correct.
Okay. So on the marginal deterioration of asset quality, so we were, and if you're referring to gross NPAs, etc., we were at around 1.6 to 1.7% in last 2-3 quarters. In this quarter, it is 1.8%. The plan which we had for the year, we had projected that we will end the year at around 1.9%. And this was a very statistical exercise which we have done, which takes into account the seasoning of the book. So in the long term, the budgeted losses and gross NPAs by product are pretty well defined. And as the seasoning of the book grows and its contribution in the overall portfolio grows, it is likely to go up a little. So this is very well calibrated, and we had forecasted, and internally we have been estimating this. So in steady state, by end of the year, the idea is to be around 1.9% or lower. This has primarily happened because the greater than 12 MOB contribution in overall portfolio is steadily increasing, and which is very well planned. So there is no need to worry. We keep observing this in very great detail, and this is as per plan. On the second question on what are the additional things which we are doing once we reach the large scale of 10,000 or 20,000 crore, I must tell you, RBI came up with ICAP guideline for NBFCs to be implemented by September of 2022. And we were among one of the first NBFCs to have a very robust framework on internal capital adequacy by clearly quantifying both pillar 1 and pillar 2 risks. So we have done a very exhaustive exercise. We all know that credit risk is the primary risk in NBFC business, but around that, from governance perspective and operation perspective, we have pretty well defined large risk areas and have tried to quantify them for next 3 to 5 years period, and that all has been documented formally. So this is one of the primary steps as a large NBFC we have taken.
I would add, addition to what Anu just said, in my 25, 27 years experience in financial services industry, and creation of an institution which started in 2018 with a listed NBFC with only 40 crore of total capital, and on the day one, without having any business, raised roughly around 940 crore of or 50 crore of capital from 4 of the largest Asian private equity institutions, set up a governance framework wherein its article provided that the majority of the board would be independent, the company would not lend more than 1% of its net worth, any shareholder which is more than 10% through primary route would get a representation on the board. I as the founder have relinquished my right in terms of the governance, how people would be hired, how people would be terminated, and also not many other things in terms of the policy and formulation. Is the first step. In India, lending businesses, whether banks or NBFC, have not failed because of the underlying size or the customer type. They have failed because of the governance itself. You can have cyclical risk, but you cannot have a failure risk. So that was the first step. Second, this is the first company which heavily invested in its people infrastructure, wherein 8% of equity was given to a management team, which came from diversified background. When we were only 1,000 crore of AUM, still the management team was fully capacitized. So 5 senior CXOs having 25-year plus experience, almost 25 people reporting into them. They all have 20 years plus experience and physical branch infrastructure, multi-layer credit infrastructure, and data analytics and technology, which is around 275 people. We are designing to build scale. And last but not least, we have been conscious that this is a business of credit and capital, and that's why at appropriate time we have raised capital. So if you look at our last capital raise, which was done on 11th of April, while we were at the lowest point of our share price point, which means that there was always a temptation to wait out and raise capital when the price improved, which then from there improved to almost 158 rupees to 250, 60 rupees, I don't know. But given that we felt that we are nearing to a capital base which was going around 20%, we avoided the temptation to wait, but raised our capital from some of the finest institutions in the world. Denmark government put in 240 crore, we did a QIP, and we brought some of the long-only investors. So I think so we are in making of an institution, and they by their, the design itself, make sure that they pre-invest when the scale comes up.
Mr. Chauhan, does that answer your question?
Yeah. Thank you for detailed explanation, and congrats for again executing on the benchmark that you yourself set. Yeah, and best of luck for the future. Thank you very much.
Thank you. We have our next question from Omkar Sargaonkar from Vasuki India Fund. Please go ahead.
Hello. Hi, is Rama
Yes.
audible?
Yes, you are, Omkar.
So my first question is on the co-lending income. So if I see for FY23 as a percentage of off-book AUM, this was around 6.3%. So how do you see this going ahead? And like what should be the sustainable rate?
So it is a factor of volumes and rates. So as the volumes would go up, the total income would go up, but our margins would remain stable in this portfolio, because as I explained in earlier question, that our rates with most of the bankers from whom we do co-lending are prefixed, and it varies only when benchmark rates vary. So there, our margins on the overall co-lending will remain almost similar what we have delivered last year, and on direct assignment side, again, it is expected to be similar. So it is a function of volume, that how much volume we will do during the period, and as we have given a guidance to the market in the first quarter that we will touch 10,000 crore of AUM and certain level of almost 3.1% of ROE, and 10% of ROE, and 3.1% of ROE. It is an important cog in the wheel to achieve those numbers. But on a broad line numbers, we expect that our last year to this year co-lending and DA income put together should remain flattish. This is what we have presented to our internal board.
Okay. And my second question is on the credit cost. So for this quarter, it is around 1.3%. But so this credit cost we calculate as a percentage of total AUM, right?
Yes.
But if my understanding is correct, we don't have any credit cost on the off-book part because that is taken up by the bank.
There are two part of our book. Sorry, there are two part of our balance sheet. One is co-origination, other is co-lending. And in our presentation, we have bifurcated. Co-origination till recently was only with the large NBFC, wherein we cover certain percentage of the credit cost in form of a first class cover. And that's why for that portfolio, we provision for the entire credit cost. And we are gradually, it is also moving in the hands of the bank. It would take time, I think. So by end of this year, banks would start taking all form of product, unsecured business loan, secured business loan, machinery, supply chain financing. So, so of our co-lended book, co-originated book, 50% is in the hands of the NBFC, and that we cover the credit cost, and that's why the provision also covers for that. Yes.
Okay. But so going ahead, would it be more appropriate to calculate this as a percentage of the on-book AUM? Is that understanding correct?
Not exactly. The correct way of probably looking at it is the balance sheet AUM plus co-origination income plus 20% of the assigned book which we have done in co-lending and DA, 10% of the DA. So if you put together, then the real credit cost should be a good measure to have a complete picture of the percentage of the book.
Okay, thank you. That is very helpful.
Thank you. We have a next question from Nirvana Laha, an individual investor. Please go ahead.
Hi, thanks for the opportunity. First of all, one request, if you could please start sharing ALM data from the next quarterly presentation, because that is something that we like to track. So if possible, please. Thank you.
We will do that, just but for so that since you asked question, we are positive on all ALM bucket, and that is also because while we do long tenor product as well, so secured loans up to 10 years, 12 years, but most of our long tenor product actually get to downsell in our co-lending book actually. So suppose I've given somebody 1 crore rupees of loan and it is for 10 years, T plus 10 days, 80% of that would go to the bank, and only 20% of that would be held in our books for the long tenor, and we match that to our equity capital. That now no total tenor or average tenor of our book should not cross our equity capital, but thank you for the. We'll see how best we can present that because the regulatory reporting structure and this whole co-lending and how it impacts the entire ALM, and it has to be looked. Is to be something to be deliberated. We will surely come back and try to find a way to best represent it to you.
Okay, sure, thanks. So in the annual report, I saw that there was about 51 crore worth of contingent liabilities, which was sort of marked against FLDG guarantees for co-origination. This is from the annual report. But now I just heard you say that it's provisioned and therefore part of the credit cost. So if it's in contingent liability, then it's not part of credit cost, right?
So we do it both, sir. So it is a contingent liability, and because of it is contingent, we are also in our expected credit loss provision, we are provisioning it. Am I right? Yes.
Okay, so the ratio that I saw was around 10%, so around 51 crore on a co-origination book of 488 crores. That was the contingent liability, and including credit costs. So is it fair to say that this number is somewhere between like around 10 to 15% is the kind of guarantee that we are right now having to give on our co-origination book?
No, so the ECL provision is an internal thing, and the FLDG is external. It is just that we are a little conservative on this. That's about it.
But yes, your math is more or less right.
So 10 plus about 1.5.
Yeah, so I think so your math is right that for last year annual report which you are seeing, because these were mostly new relationship with large lending institution, the total contingent liability against that outstanding portfolio is in the range of 10%. With every passing time, it is coming down. But the credit cost of that, which can come to us against that contingent liability, we are provisioning simultaneously.
Got it. But you see it coming down, right, from this 10%?
Yeah, as I said, that we would endeavor, and that is the endeavor which is happening. So, one of the second largest public sector bank in India, we have gone live on what we call option one, fully digitally integrated, system for a business loan, wherein 20% would, at the point of origination, underwriting and disbursement is happening from us, and 80% is coming from the bank. And once that happens, then this contingency would keep coming down. Obviously, the difference would be adjusted in price. So think of this way, I go to a very large AAA NBFC, I originate a business loan with them, they give me a price of say 10.5%, I give them a 5% first loss cover wherein the credit cost is expected to be 1.5%, I take the provision of that 1.5% in my ECL. But if I go to a large public sector bank, which I cannot give any first loss cover, the price would go up from 10.5 to say 12.5, but they would release our both contingent liability as well as the ECL provision.
Got it. Got it. Thanks for the explanation. So on OPEX cost this quarter, I think we have done very well. We are flat QOQ, even though there's been a lot of growth. So do you see this run rate maintaining over the next few quarters? And there's been a 3.2 crore employee cost reduction quarter on quarter. How is that?
So it is how as we have given the guidance at the beginning of the year that we are capping on our overall OPEX. So it is likely that it could go up slightly from where we are because the inflationary factors keep on pushing it up a little. So probably on a holistic basis, we may not be significantly higher compared to what we have spent during the quarter, but it is not static. It will not be flowing in all the 4 quarters during the year. And this reduction in employee cost is the factor that whatever we have done our PMS during the first quarter of the year and whatever incentive, etc., we have factored in, probably the outflow was little lesser compared to what we have budgeted for. Hence, there is a reduction, but as we progress, it will catch up.
Okay, thanks. And last, if I may squeeze in, Anuj, what you described about the model was very interesting. We would like to hear more about the model in the next calls and presentations. If I can ask just a couple of questions on that. So every loan application right now in UGRO, does it go through the GRO Score 3.0 process?
Okay. Every loan except for micro loans, because in micro enterprises, there is not enough data to analyze. So the platform requires bank statement, GST, and repayment behavior. But for very small customers, sometimes we don't get bank statements, or if we get the number of it's very thin bank statement. But other than micro enterprises loans, everyone else goes through the GRO score.
Okay, and for micro enterprises, you would have manual scorecards.
So we have an abridged version of the same GRO score, which only takes into account the repayment behavior.
Okay, and is there a manual override to a grow score? Like if grow score 3 says that the score is good and you can lend, it's A, B, C, or whatever the bands that you classify in, is there a manual layer of override after that, or is it?
So the gross score gives a probability of default. So A, B, C, D, E, each against each, there is a probability of default which is getting estimated. So depending on what kind of product we are doing, we have internally made a cutoff of what should be a straight reject. So typically a gross score of D and E under most circumstances would be a straight reject unless we find that there has been an error in reporting in bureau. This can happen, but although very rarely, but this can happen. Sometimes there is an error in reporting and that's why the machine has read it wrong. But other than that, there are very clear guidelines on which are to be straight rejects depending on which products we are applying it to. But credit officers have authority that for a scored customer, if he has found something which he is not comfortable with, or our sector and templated underwriting scorecard is not stacking up, or suppose our FCU and fraud control unit has red flag something, or the collateral quality is not as it is expected, credit officers can say no. Yes.
Okay, do we have data on like what percentage of A or B there is a manual override where we don't lend? Like what percentage would
the approval rates in gross score A and B are in the vicinity of 50%. So 50% of gross score A and B are still getting declined by underwriters for various reasons. It could be reference related, it could be collateral related, or it could be something else. An idea is to bridge this gap over a period of time.
Right, got it. Thank you so much, guys, for patiently answering. And Anuj, we would like to hear more about the model from you each time. Thank you.
Thank you. We have our next question from Pruthul Shah from Anubhuti Advisors. Please go ahead. Mr. Pruthul Shah, please unmute your microphone and go ahead with your question.
Pratulji, good to see you again. Can you hear us?
We can take him back again. Let's go to the next participant.
Sure, sir. Please stay connected. We have a question from Ruchita Kadge from iWealth LLP. Please go ahead. Ruchita?
Hello, sir.
Yes.
Yes. Yeah. So my question was on the ROE that you've guided for, which is 18%. So is this without a capital infusion that you'll have to do by the end of the year, or with that you're guiding 18% ROE?
With the capital infusion, ma'am.
With the capital infusion.
And this ROE is not the guidance for this year. This guidance is for next year.
I know.
It is what we want to achieve on a sustainable basis.
Okay. So 25 and ahead also.
But target is to get there by 25 and maintain that thereafter.
Understood, sir. Understood. And this year ROA would be 3.5% is what you're expecting.
No, ROE would be closer to 10%. ROA would be 3.1%.
3.1%. Okay.
Yeah.
And the tax rate would be?
29%.
Okay. Understood. Thank you.
Thank you. We have a text question from Mr. Tushar Malhotra from Advaita Advisors. What is the difference between return ratios, that is ROE and ROA of co-lending side and co-origination? And the second question is, what is the percentage of customers we fund without GST data, both amount of AUM and number of customers?
Return difference to the is asking on the last slide.
Yes. So co-lending, co-lending returns look superior if you have gone through our investor presentation. It is largely because we earn same amount of income, almost same amount of income by deploying much lesser capital. So in co-lending, 80% of the exposure is being taken by the banks, and 20% exposure remains with us. And the margins are almost similar. So our capital attachment to the servicing the same kind of exposure is much less. Hence, the returns are far superior compared to on-balance sheet lending. On the there was another question
on the how many what is the percentage of AUM and number of customers which are without GST?
So roughly about 20% of the AUM, 10% is close to our micro enterprises division, and 10% of partnership and alliances. These are typically customers which are very small in size and GST is not applicable to them yet. But I would point out that these are all secured either by a property collateral or by FLDG.
Thank you. We have a question from Pruthul Shah from Anubhuti Advisors. Please go ahead. Mr. Pruthul Shah.
Pratulji, we can't hear you, so you can write your question in the text box if you are not being able to, if the voice is not coming, we will answer that as well.
Yes. Meanwhile, we'll take the next question from Anil Tulsiram from Contrarian Value Edge. Please go ahead.
Yeah, thank you for opportunity once again. Sir, can you describe how has been the journey of your microloan branches and what has worked and what has not worked well, and how sooner can we scale this particular segment? Thank you.
Yeah, just I want to make a clarification so that people don't get confused. Our microloan means micro enterprises loan. We are not in microfinance business because a lot of people get confused. Yeah. Our average ticket size is around 7-8 lakh rupees. It's largely secure business. If you want to take that.
Yes, so Anilji, and for everybody's reference, we set up our 75 branches by Q4 of last year. So we had this one full year to do the proof of concept. All our branches have now broken even effective Q1 of this year, which means our hypothesis that a branch will take about anywhere between 15 to 18 months to break even has been proven right. So that's number one. Number two, the branches have now started delivering above market or above peer set disbursement month on month. So we do about between 85 to 90 lakh rupees of disbursement on these branches month on month. And you people should compare this with the peer sets where the micro enterprises business happens. So it's at least 20 to 20% up above the market average. Having said this, having seen this very encouraging trend, I think by end of this year, we will take, or the end of Q3, we will take our decision between end of Q2 and Q3, we will take decision to enhance this distribution so that when we enter the 24-25, we will have large set of this distribution ready to deliver throughout the year and therefore delivering to the bottom line.
Anilji, as entrepreneurs, we would like to continue building and expand. We get very motivated when we travel to tier 2, tier 3 towns. We see the untapped market opportunity, and we think we have so much to do, and that's why we are not doing, so quickly. But the fact is that we are compared to 15, 20-year-old established NBFC and organization. Capital being precious to us, and we need to attract capital all the time. You have to sometimes take a halt in terms of how much more you can build out. So we are in that place. But as we do the first stop of delivering, performance on our bottom line, I think we have said that we have identified 280 plus locations within the 5 state itself. And once we are nearer to our current year of financial target, we will trigger the expansion on that, because that is not only very profitable business, which can, enhance our ROEs, and will actually achieve those ROEs because of that. But also it serves the purpose of solving the real problem of credit into Bharat, not in India.
Yeah, thank you. Sir, the second question is regarding your prime secured loan. Can you help me understand the profile of these customers? And you have said the average ticket size is 70 lakhs. Can you give a range to where exactly the maximum lies in? So that's it.
So, so the average profile of a prime secured customer is typically the sweet spot is between 5 crores to 10 crores of turnover. He is typically a manufacturer or from a service industry. More importantly, he has a very strong financial discipline, which means there are strong banking habits. There is a regular discipline on the GST, because of which we are able to evaluate him basis our gross score model. So that's first. So that's the profile of between the turnover range and what kind of business does he do. Secondly, when we talk about 70 to 80 lakhs of average ticket size, these when we go across tier one and across the metros and tier ones, what we are talking is about a 70% average loan to LTV ratio, and therefore a property of anywhere between 1.2 to 1.5 crores as an average collateral value. So that is the customer whom we are talking about, 5 to 15 crores of turnover and a property of 1.5 crores that he can mortgage to us.
Yeah. So, sir, is my understanding right? Ki maximum of your customers' turnover is around say max 10 to 20 crores and not beyond that?
Yes, in fact, let's say 10 to around 10 crores is where the sweet spot is.
Max.
Max, not even 20.
Thank you. Sir, and my last question, any update on what is the development on the OKN and by when it is expected to, you have any insights on that, by when it will get implemented, Open Credit Enable Network?
It is live, sir. So Oken is already live. The financing options in Oken is currently what the government is working upon. But Oken as a concept is already live. In fact, we were the first implementation of Oken. So the government e-marketplace GEM and its financing platform called GEM Sahai is on the Oken concept, and we were not only the integrator for that, we were creator of that. We host it in UGRO Cloud. So all of that was done.
No, what I meant is it was expected that this protocol will be adopted by mass like say Swiggy, Zomato, Uber, and everyone will join this segment and there will be distribution of this loan.
No, sir. So that's what I'm saying. The concept is there. So there are multiple elements of that, right? What is Oken? It's that your account aggregation is part of Oken, which means that you can fetch the banking data. Now GST has been made part of this, which means on the account aggregation itself. So with a single OTP, you can now fetch the GST, you can fetch the banking, and then on such platforms, lenders can come. Now the loan service providers, which is like a Swiggy, Zomato, large corporate has to also come. So they, Oken is a concept. There is no physical platform per se. Now the infrastructure is ready. So on a platform where on account aggregation, your bank and GST has come, and if there is somebody develops a protocol, this GEM decided to do GEM Sahai. For example, GST Sahai Sidbi is doing that. So you will see over a period of time, the uses of Oken as a concept would increase, and that is happening over a period of time.
Thanks a lot, sir. Thanks a lot and all the best.
Thank you. We have a text question from Mr. Prasad Deshpande, an individual investor. While FY25 off-book AUM target is 50%, theoretically one can do 80% off-book. What range do you see the off-book AUM mix settling down in steady state in a few years from now?
Ideally, for now, what we can perceive is that 50% we would like to maintain, simply for two reasons. One, we are a principal partners to lending institution, and I think so the rule of principalness or principality comes when we are equal partners. We keep increasing that, and which is economically and return perspective is very attractive. Then we will lose the confidence of the banking institution which are partnering with us. Number two, on the ground, we are innovators of multiple types of loan product or multiple types of customer profiles. Banking systems adopt them with lag effect of seeing the performance of that in our own book. So for example, if we created GrowX, wherein it's a credit for a small merchant. It has very high tenacity. We can give a loan in 10 minutes time. It comes back every day. If I take on the day one this to a large public sector or private sector bank, it would be very hard for them to adapt. But if we do that for a period of time of say 6 months to 1 year on my balance sheet, show its performance, then the bank comes to us.
Micro enterprises loans.
Same as the micro enterprises loans.
Excellent example. So in micro enterprises loans, now is when we've tasted success with our co-lending partners. However, go back 15 months ago, I think they were still trying to understand the segment, skeptical. So that for that reason, we will have to build our own books, and because of they are very profitable businesses, it is good to have them on your books as well.
We have a text question. Should I go to the next one, sir?
Yes, please go ahead.
We have a question from Mr. Pruthul Shah from Anubhuti Advisors. The first question is AUM for FY24, 10,000 crore, FY25, 20,000 crore, and beyond that 30% CAGR in AUM. Is this understanding correct given the guidance on slide 7 in recent presentation? And the second question is in slide 14, what is the difference between gross yield and net yield? Is it the commission paid to partners?
On the first one, yes, Pratulji, you are right. But I would just with disclaimer, these are aspirational numbers which we would like to achieve. But wherever it comes to the arbitrage between delivering the bottom line performance by sacrificing 1,000 crore of AUM, we will prefer and choose the bottom line performance. Be cognizant, so don't punish us if we are not at 20,000 crore but 90,000, 19,000 or 18,000 crore. But we are at 18.5% of ROE because we choose an 18.5% ROE versus a 10,000 crore of AUM, and this is a culture which we are building. Yeah, and gross and net yield is the same.
Yes, you are right that it is gross. The difference between the gross yield and the net yield is the difference which we pay to the partners.
Yeah, it's not commission, it is the partners. So in our P&A channel, the partner may be doing at X percentage, and because he covers our losses and his services originate, and co-underwrite with us, that difference goes to him for that.
As there are no further questions, I would now like to hand the conference over to management for closing comments.
Thank you very much for spending the time. And also, we have seen for first time, we are seeing UGRO really as a public company. We are seeing increased number of retail shareholders. We are seeing increased number of, high net worth investors. We are seeing institutions, PMS, AIF participating in that. Successes of companies like ours, whether it's an HDFCs or ICICIs of the world, is dependent upon the support from shareholder across the board. We were successful in getting large marquee PE investor to support us, and we expect in the next 5 to 7 years, broad-based shareholders to support us in terms of making UGRO as India's largest financial institution around small businesses, because we think India belongs to Bharat and Bharat belongs to SMEs, and besides delivering profit and returns, we are doing good to the society by creating this business. Thank you very much and see you again.
On behalf of UGRO Capital Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.